Hey everyone, welcome back to the Mass Retirees Weekly Update. Today's Friday, October 11th. I'm Sean Duhamel. Thank you so much for joining with us and tuning in again this week. Now, before I get to the news of the week and update you on what's going on, I want to first say for our members living in Florida, I hope everyone is safe. On behalf of our entire team here at Mass Retirees, please know that we're thinking of you. We couldn't help but think of our members as we're watching the news over the last few days and seeing just those horrific images, whether it's from Hurricane Helene or the most recent Hurricane Milton. It's just been one tragedy after the other. So I hope you're all safe. As Frank Valeri said in his email blast earlier this week, if you have been displaced or if you need help with anything, give us a shout. You can find our contact information, our personal contact information, of course, is on the back of your membership card. Even if it's just something as simple as changing your mailing address or your bank or whatever you might need, reach out. We're here for you. Or if nothing else, just know that we're thinking of you. And I hope all of you, again, are safe and that you've made it through this really terrible time being okay. So with that, let me jump into some of the news of the week. And first and foremost, I want to thank those of you who took the time to attend either our Pittsfield meeting on Tuesday or our West Springfield meeting on Wednesday. We had great crowds at both meetings. It was wonderful to see so many familiar faces once again in person, along with meet some new members who have literally just joined. As a matter of fact, we had one member who just joined. He's a state retiree, drove all the way out to West Springfield on Wednesday from Brookline just because he wanted to attend his first meeting and he had some questions on things. So coming in person to our meetings really gives members the ability to speak with us one-on-one, whether it's a personal matter, whether it's a complaint or a concern, whatever it might be, or even if you're just curious as to who we are and what we're all about. That's why we meet in person. It's one of my favorite parts of working for you. Is being able to interact with members one-on-one in person. It's great to be able to talk to you through these videos and our teletown halls and all of the other communications tools that we use, but there's nothing that replaces that one-on-one or one-on-one just direct contact with each other. So over the coming weeks, we have a meeting a week from today on Friday, October 18th in Plymouth, where I grew up, and it's going to be wonderful to be back in Plymouth for the afternoon. That start time is at 11 a.m. The meeting takes place at the 1620 Hotel, right downtown on the waterfront in Plymouth. With any luck, the weather will be beautiful. There's really nothing better than being down on the ocean where I grew up and when it's beautiful weather like we've been having. So let's hope that next week turns out to be a good day. But then we also have 2 more meetings after that to round out the end of 2024. In November, we will be down in Westport, Mass. At Whites of Westport. And then in early December, we will be back in Auburn, Mass. At the Auburn Elks for our final meeting of 2024 before we kick off our 2025 meeting schedule. And we'll be making those announcements in the coming months just so you can plan, get it on your calendar, and hopefully come out and say hello. So with that, let me move into some news of the week. The good news is that just yesterday, the Federal Bureau of Labor Statistics, which calculates the annual consumer price index, the CPI, came out with what the CPI has been for the past 12 months. Now, the federal fiscal year runs from October 1st all the way through to the end of September. That's the federal fiscal year. And that's the calendar that the CPI is based upon. So over the past 12 months, according to the Bureau of Labor Statistics, the CPI comes in at 2.5%. This is the lowest level the CPI has been at over the past 4 years. We all know through the pandemic and through all of the results of the pandemic, inflation spiking and so forth, the CPI went through the roof and is now back down into more of a normal range, back down in the range in which the Federal Reserve is hoping that the economy on average grows at, and that's around 2%. So those of you who are receiving a Social Security benefit, your benefit starting in January will increase by 2.5%. Now, while the pension systems here in Massachusetts, whether it's the state and teacher system or the 102 local systems, they look at the CPI as a guide in terms of the annual pension COLA. but the pension COLA is not based on the CPI. It's strictly a guide. And the reason for that is that unlike Social Security, in which the CPI, in this case 2.5%, is based on the full Social Security benefit, our pensions are limited in terms of the COLA base. And the COLA base across all 104 systems ranges from a low of $12,000 all the way up to a high out in the town of Montague is at $30,000 for their base. Now, baked right into the pension funding assumptions of nearly every single system, maybe with one or two exceptions, is a 3% annual COLA. That's baked right into the funding, and it's an assumption that that 3% COLA will be paid year in and year out. So even though the CPI comes in at only 2.5%, our hope and expectation is that all public retirement systems in Massachusetts will be paying a 3% COLA on whatever their base may be. And this is kind of the trade-off that exists between how Social Security operates, which of course is on a pay-as-you-go basis, versus our public pension systems, which must be fully funded and pay for these benefits going forward. Now, in terms of the COLA, all of this kind of relates back to the special COLA commission that we helped create as part of the FY25 state budget that Governor Healy initiated back in January. That special COLA commission is now law. We anticipate it finally getting up and running over the next couple of weeks. Frank Valeri will be our designee on the commission. We have a seat at the table. And the goal and the focus of the Special COLA Commission is to make improvements to the COLA base, the state and teacher base being first and foremost, which is significantly lagged behind many of the municipal systems. But the COLA Commission will also be looking at how to fund future COLA benefits, because that is a significant hurdle that we have to overcome in terms of increasing the base, whether it be at the state level for state and teacher retirees or at the local level. These benefits must be funded over time, and coming up with new ways of addressing those funding obstacles within the context of the pension funding schedules will be a major focus of the Special Commission. So that's a major thing that we're focused on going forward. Now, another topic that we are very focused on and very, very concerned about, and we've been talking about those concerns for the better part of 2 years now, is retiree health insurance, and specifically the increases that are likely coming in 2025 in terms of Medicare premiums. Both Medicare Advantage plans and Medicare Supplement plans are most likely going to increase. I'm talking about the monthly premiums that all of you pay for your coverage. Those premiums most likely are going to increase by the double digits. Now, the exact amount and percentage of increase is going to vary across the board. It's going to change depending on which plan you're enrolled in, which community you're retired from, which healthcare purchasing group that your community might be part of. Generally speaking, the larger the entity, the more people who are enrolled in that plan, usually gets a better rate. That's not always the case, but as a general rule, in this instance, the larger the plan, the less expensive it's going to be, but it's going to vary. So in this week's message, we're not getting into specific details from community to community of what these increases might look like, because the short answer is we just don't know at this point. We will get that information in the coming days and weeks, and once we do, we'll be providing additional information to all of you. But this does not come as a shock that these rates are going up. However, it's surprising that we're looking into the double digits. Quite honestly, a couple of months ago, or even a couple of weeks ago, we would have guessed we were looking at an increase of somewhere between 5 to 10%. Now, from what we understand, it's going to be higher than that, in some cases much higher than that. The reasons that are driving this, and a report that just came out yesterday, coincidentally, from the state's Health Policy Commission, and you've heard us talk about this and write about this over the past few years. HPC is one of the national leaders in terms of healthcare analysis, looking at cost trends, what is the cause behind some of these increases, but also coming up with recommendations of what can be done about it. Trying to control the growing cost of healthcare is a major concern to everybody. So HPC plays a central role in all of that. One of the findings of HPC, and we get into the details of this within today's email message. So if you're watching this video on YouTube or on Facebook and you're not a member of our association, please consider joining. You can do so online at massretirees.com. The button to join is right up top in the banner. Click on it, become a member of Mass Retirees. You will then receive our weekly email update that provides full details of the things I'm talking about in this video. And if you already are a member of Mass Retirees, please look to today's email message. It comes out from me under my name every Friday morning at 6 a.m. If you're a member of our association, you're not receiving the weekly email, let us know. We'll make sure we have the correct email address for you on file so you get that important information along with everyone else on Friday mornings. But as we detail in this week's message, there are various cost drivers, and the report out yesterday from HPC has found that one of the factors in these increasing costs is not utilization. It's not the fact that retirees or active employees are going to the doctor more or accessing more services or medical care. It's being driven by higher prices being charged by doctors and hospitals and medical providers, and especially pharmaceutical companies who are unbound by any restrictions whatsoever in terms of what they can charge you, charge the state, charge our health insurance plans for these critical, life-saving, life-altering medications that are so essential to all of us. And it's just driving the costs higher and higher and higher. Now, in terms of Medicare premiums, things get even a little bit more complicated in terms of what is causing these prices to go up. Now, it's everything from medical inflation, like I just explained, to the fact that the federal government has changed and in some cases cracked down on the practices of Medicare Advantage plans. Now, there are some good, very good Medicare Advantage plans, and the one run by Blue Cross and the other one run by Tufts here in Massachusetts that some of our members are enrolled in. Those are good Medicare Advantage plans, but they come with certain restrictions. So as we have said in the past, when it comes to Medicare Advantage, buyer beware. Make sure that the doctors that you see and the hospitals that you need to visit are included in the networks that are attached to Medicare Advantage plans, because oftentimes there are restrictive networks as part of a Medicare Advantage plan. That's one of the reasons why some of these plans tend to be less expensive than traditional Medicare sup plans. But the federal government has begun to crack down on some of these plans. They've changed the reimbursement rates and practices that are available for Medicare Advantage plans, and that's caused some pricing ripples through the marketplace. But there are also other reasons as well. One of them being an unintended consequence of the new federal law that was put through as part of the Inflation Reduction Act, which puts a cap in place for Medicare enrollees in terms of your prescription drug out-of-pocket costs. If you're a Medicare enrollee, the federal government limits out-of-pocket costs for prescription drugs to $2,000 per year per person. Well, that sounds great, and it is great on the surface, because we don't believe that any individual retiree should be saddled with these out-of-control prices. It's not your fault that you're sick or you're hurt and you have to take different types of medications. And it's unfair to saddle an individual with thousands of dollars or even tens of thousands of dollars in out-of-pocket costs over the course of a year. Unfortunately, these prices and costs need to be paid by somebody. And instead of the individual bearing the burden of paying all these costs themselves, they're now being spread out amongst the premiums for all retirees. And it has long been the position of our association that we would rather see medical costs spread out amongst everybody, that all of us are paying a small share of the total burden, rather than forcing those who can least afford to pay, who are the sickest amongst us and are utilizing the insurance, to force them to pay these exorbitant prices. It's just not right, it's not fair, and that's been the position of our association. But that's one of the reasons why these costs are going up. Now, coincidentally, we found out about these rising costs just days after the Municipal Healthcare Summit that Blue Cross and Blue Shield hosted last Tuesday. And it just really reinforced the importance of why we've been holding, this was the second annual summit, bringing together public retiree and union leaders to work with our local insurance representatives on the public employee committees and on the insurance advisory committees to give our local members the information and the tools they need to represent the interests of municipal retirees and municipal workers at the bargaining table when it comes to your health insurance, and being able to defend your benefits at the local level. Because our greatest fear, in addition to the affordability crisis, that every time these prices go up, more and more of our members are struggling to pay those prices. Beyond that, we have a great fear, particularly at the local level, that as local budgets continue to tighten, and as these costs keep going up, because remember, every time your costs go up, the cost for the government also goes up. Because at the local level, the minimum contribution is 50-50. The average statewide contribution, we believe, is somewhere around 70-30, with the municipal government picking up 70% of the cost of your insurance premiums. At the state level, it varies depending on when someone retired. It ranges from 90-10 to 85-15 to 80-20. So at the worst case scenario for the Commonwealth is that they're picking up 80% of the cost of insurance for state retirees. Now at the state level right now, we don't know what the impact of these rising costs will be on the GIC. There will be some impact, but the GIC works on a different calendar than municipal plans when it comes to Medicare. The municipal plans, by and large, reset in terms of their premiums in January. That's why these prices are coming out now. The GIC resets their premiums on July 1st. So the GIC will not be making plan design decisions and insurance premium decisions until January and February of this coming year, maybe even into early March in some cases. We won't know for another 4 or 5 months what the impact on the GIC may or may not be. So there's some time there, hopefully, to mitigate some of this. But at the local level, once these prices hit, we know full well that we're going to see some local government saying, hey, we can't afford to pay for this anymore. We need to change things, whether it's changing insurance premium contribution splits, looking to change plan design, looking perhaps to bring in inferior insurance plans and policies that are a non-starter for our association. These are the things that we're concerned about. These are the things that we're going to be focused on going forward. So while we don't have the ability to control overall the healthcare marketplace and stop these prices from going up, despite how much we're trying and we're nibbling around the edges, and some of the initiatives that we're involved in, whether it be IBIS, EO Care, some of the other partnerships that we've been working on, working very closely with WellPoint at the state level and Blue Cross and Blue Shield at the local level, that's helped the overall situation. But many of these problems can only be resolved at the federal level by the U.S. Congress. And we don't have the ability to force Congress to act, unfortunately. So with that, we're going to do all we can to protect your benefits, to work with state leaders, to work with the GIC, work with local leaders, work with our insurance partners, to do everything possible to mitigate any of these increases, that we can try to protect your ability to have the best quality and the most affordable health care that's available to anybody. But with that, if you're hearing about any changes at the local level, any rumblings that your local city or town is considering changing something when it comes to health care, give us a call. Call Nancy McGovern, call myself, call Cheryl, call Frank, call Bill, call Trish. Let one of us know that, hey, I live in Haverhill, I live in Plymouth, I live in Boston. This is what I'm hearing. That way we can work with our local labor allies and get out in front of these issues before the horse leaves the proverbial barn. And at times we can head off the worst impulses at the local level by getting out in front early on. So let us know what you're hearing. The last point I want to make today is simply to say thank you to those of you who have taken the initiative to voluntarily donate and contribute to our Public Retirees Political Action Committee. You know that last week we mailed out the second phase of our annual PAC drive, and within days of that letter hitting, we started getting online contributions as well as mail coming back to the association with contributions from members. Your generosity never ceases to amaze us. We are deeply grateful to just how supportive and dedicated you are to our association. And there is no doubt that our members are not only well informed, but constantly engaged in the process and know the importance of the PAC and what it does in terms of enhancing our ability to fight for you, to protect your benefits, and hopefully improve the quality of everybody's life. So from the bottom of my heart, thank you so very, very much. If you have not yet contributed to the PAC, it's completely voluntary, but I certainly hope that you'll consider doing so. You can contribute online on our website or by mail, and the information is contained on our website. It's also contained in today's email blast to all of our members, as well as in the letter that came from us last week. But with that, I'm going to log off for today. Sorry for the length of this message. I had a lot to report, but thank you so much, and we'll talk to you again next Friday. Bye-bye, everybody.